Hello. Welcome to the BBA's Big Bites staking panel, moderated today by my fellow BBA board member and events co-chair, Jim Knox. I'm Karen Knox, no relation. Before we let Jim dig in today and get to hear our esteemed panelists on staking, I'd like to give a plug for why the BBA is so wonderful and why you should be a part of the BBA. So what is the BBA? The BBA's vision is to provide education, advocacy, and community for the blockchain ecosystem in Boston and New England. And we are able to do all of this due to our corporate sponsors. We have at the platinum level, Mass Tech Collaborative, gold sponsors, Aon, thank you, Jim, Ava Labs, FCAT, Fidelity Investments, Ripple, and silver, Algorand, Amber Data, Coinbase, KPMG, Ropes and Gray, Stand with Crypto, and our business partners include Block Health, Crypto Recruiters, Israel David, Keybridge Advisors, Media Shower, and Solana. Our startup members are Develop Medicines, FYEO, Influx, and True Tickets. And our community partners include BU's Questrom School of Business, Digital Business Institute, the Federal Reserve Bank of Boston, FinTech Women, Niche, Suffolk University, and Tab Group. So get involved. We would love to have you as a corporate member, or you are absolutely welcome to join as an individual member or serve as a volunteer. We would love for you to be in touch. You can reach out to any of the board members, me or Jim, anyone else on LinkedIn. Feel free to be in touch. And with that, I will let Jim Knox take it away. Enjoy.
Karen, thank you very much. Can you hear me, Karen?
Yes.
Great. Karen, thank you very much. Hello, everybody, and welcome to our Big Bites presentation today. Yes, I share the last name with Karen Knox. We're also co-chair of the events committee of the Boston Blockchain Association. Really excited today because it's not often that we get really the leading industry leaders all together in one place, one time, to discuss an important and growing topic right now, staking in the digital asset industry. So really great to have everyone here participating. I'll do some quick introductions. Allison Mangiero, Head of Staking Policy and Industry Affairs at the Crypto Council of Innovation. Alex Aminyuk, Director of Strategic Opportunity Digital. Ernest Aupetit, that's my best shot of French. Ernest Aupetit, CPO co-founder of Kiln. Josh Deems, Head of Americas at Figment. So everyone, thank you. Really appreciate everyone joining. All right, so the topic today du jour is staking. And I'm sure most of our listeners have heard the term if they're somewhat involved in the digital asset industry, but not really sure how much they know about staking. And it's a growing industry. It's very important, frankly. There's big news made today about some staking activities. So, Sasha, maybe I'll start off with you. Can you describe just high level for the audience today, what is staking?
Sure, thanks, Jim. So, very concisely and simply put, staking or proof of stake, as we'll be talking about today, it's a concept of using collateral instead of, for example, something like energy or compute power to provide proof that you're trustworthy in a system. So you put up collateral, usually tokens, which is referred to as stake. And then if you cheat or behave detrimentally to the network or system, the network, by its consensus model, can take away some of your locked tokens, your collateral, and impose a penalty, for example, slashing or other penalties depending on your behavior. So it's a way to create aligned incentives in a system using collateral or skin in the game in order to update a blockchain ledger.
Great, thanks, Sasha. And my understanding is back in 2017, Allison, there was a kind of a big pivot from proof of work to proof of stake. If you could explain to the audience here, what was proof of work? That was prevalent up until 2017, still somewhat prevalent, Bitcoin and other protocols. But why the move to proof of stake? Why was that done? Frankly, what did it accomplish?
Yeah, so I think one important thing to remember is, in order for blockchain networks to continue to exist, for them to maintain themselves, and for the participants in these networks to agree on what is true and which transactions are valid, they need some way to come to consensus. So with the Bitcoin network, you have basically the way that transactions are validated and new blocks are added to the chain was by a system called proof of work. So Bitcoin miners are rewarded with new Bitcoin when they basically are first to the finish, using lots of compute power in order to solve incredibly complex problems and be rewarded for doing so, right? With proof of stake, you have a system where, again, it'll vary by network, but all token holders are able to participate in securing and maintaining the network. And so a particular blockchain's consensus mechanism will have certain ways of picking who can validate the next transaction, add blocks to the chain, and be rewarded in the forms of new tokens for doing so. So why did this happen? I mean, we see it happening because that was where the builders were going, right? Bitcoin, obviously, I'm a big fan of Bitcoin. Many of us are, but it is incredibly energy intensive. And I think folks who are building these blockchains were looking for new ways for folks to be able to come to consensus. And we started seeing many of the first natively proof of stake chains launch around that 2017 period. And of course, you had Ethereum post merge shift from proof of work to proof of stake. So now the vast majority of the newer blockchains, I guess we would say, use proof of stake or some form of proof of stake consensus.
So thanks for that, Alison. So was it like one main driver, or was it a factor of drivers, different factors that led to the change? In other words, what I'm hearing from you is there's a pivot from proof of work to proof of stake. Energy was a big factor, energy efficiency. Is energy a factor? Was rewards a factor? Was yield a factor? Like what's behind it?
Ernest, I'll say, I mean, I don't know if you want to jump in. I would say scalability is a big factor. There's a number of factors that really led to this change.
Yeah, sure. Hi, everyone. Totally agree with everything Addison said. I would add one other factor I think that's interesting is staking lowers the barriers to entry for new validators who want to come in, because effectively the hardware and energy requirements, as Addison mentioned, are several orders of magnitude lower than being able to run a competitive mining operation on the Bitcoin network. And so effectively for newer chains that needed to bootstrap a validator network, and all the chains came after Bitcoin, of course, but there's more and more new chains, and for them to bootstrap this initial set, staking is a more elegant process because effectively you can do it with consumer grade hardware that you get, well, either from in most cases from cloud providers, but also some people can run validators at home. And that's an attractive proposition for certain decentralization properties of the network and for just getting new people to participate.
I'd also just add I think just to make it, one of the things that I think about is Bitcoin was such an amazing invention and an amazing just social experiment in the first couple of years that it existed. It really just operated, in like complete gray area. No one really knew except for those in the which allowed Bitcoin to really, sorry, dog barking, allowed Bitcoin to really grow and scale without, needing a heavy amount of compute power that it does today. If you were to try and launch Bitcoin now, it would be effectively impossible. So as these new chains came to market and were promising things, like the Bitcoin network settles once every roughly 10 minutes. So if you were to settle transactions every 10 minutes, but you're required to, process micropayments and have speed and efficiency, as Ernest and Alex and Allison were saying, the same way as you would on the Visa network, the Bitcoin network is actually really not good for that because of the amount of energy input that it takes in order to achieve consensus through proof of work. Proof of stake allows for speed. And so, again, we would never be able to launch a proof of work network the same way Bitcoin was launched ever. And so in order with the trade-offs of Bitcoin being speed, efficiency, and cost, to be able to do that in the most efficient manner, and build a full operating blockchain, the best way to do that was proof of stake. So that's why we saw it sort of emerge as the preeminent operating system consensus mechanism for blockchains. And pretty much every blockchain that has been launched since 2017, maybe some outliers on the periphery have been some form of proof of stake. We've not seen really like another proof of work chain come to market.
Yeah, it's a great point. Josh, I can totally agree with you. Great invention, Bitcoin. But the big knock has always been the energy drag, the speed of payments. It's just not working, or not working as well as say proof of work, proof of stake. Hey, so I want to follow up on that. You mentioned about all these new protocols since 2017 on networks, Josh. So let's talk about that a bit. As regards staking, are some networks have advantages over other networks being staked? Are some more dominant than others? Could you get into that a bit? Just kind of educate us and the audience on, if someone's coming into staking, what they should be looking at, what protocols, what networks are kind of ideal, if any are ideal.
I can start with the first two biggest, and I'm sure people, other panelists have opinions, and there's certainly like not one size fits all from a proof of stake perspective. The two biggest by market cap, and therefore, from our perspective, the two biggest that we see from client interest, institutional client interest, are Ethereum and Solana. And Ethereum and Solana they're both proof of stake networks, but they're very different in how they implement that. So, as Allison was saying, like Ethereum actually was originally a proof of work network that switched to becoming a proof of stake network about 3 years ago. And it's sort of like the whole premise behind Ethereum is modularity. So you sort of build on top of this base blockchain. You can build what's called layer twos, which mean faster settlement. But that faster settlement happens a layer above the actual base blockchain. Solana, the goal of Solana is actually to not have these multiple layers of other chains. Like people have probably heard of Polygon or Optimism or Base, even the Coinbase's product. Those are layers built on top of the Ethereum blockchain. Solana doesn't really have that same concept. So these are two of the largest proof of stake networks. They're operated very differently. There's modularity to Ethereum. There's less modularity to Solana. There's also something called delegated proof of stake versus what I would call pure proof of stake. Ethereum, you have one basically account to one validator. No, I'm introducing new terminology here, but validator is effectively a connection point to the blockchain network that's validating new transactions, validating new blocks of data. Um, on Ethereum, you have sort of one person, me, Josh. If I want to operate a validator on Ethereum, it's kind of like here's Josh's validator. And if Allison wants to operate hers, here's Allison's validator. Ethereum works with millions of different validators approving transactions and sort of being synchronous in the way that they're voting on the state of the chain. Solana manages to do this with a much smaller set of validators. It uses something called delegated proof of stake. Um, so Ernest, Sasha, and I all work for companies that operate large Solana validators where people are delegating to one node. So like Jim and Josh and Allison could all be delegated to, Figment's proof of stake Solana validator, and Ernest and Sasha could be staking to Kiln's, Solana validator. It supports multiple um, accounts staking to a single sort of validator entity. So there's obviously some trade-offs with the design of that model. Those are the two largest networks, the two that we've seen, institutions launch ETFs around that have staking within them. We've seen, large banks get involved by building, programs that stake these two assets. Those are the largest. There's obviously a whole litany of others that I'm sure people are interested in we get into, but from my perspective, that's where we see the most of our client demand is around those two largest assets.
So you just mentioned ETH and Solana are the two largest. If I use analogies like GM and Ford, they've been the big dominant for years. Do you see it continuing that way? Do you see others coming along disrupting ETH and Solana? What do you guys think?
Oh, sorry, Alex, go ahead.
Sure. Thanks, Ernest. Yeah, I mean, by way of history, you're like back in the sort of heyday of proof of stake when everything started, 2017, 2018, there were dozens of different proof of stake chains launching, some of them even hybrid proof of stake, proof of work. So there were a lot of ideas floating around, about how to secure the chain, how to build networks with a certain inflationary model, certain consensus algorithms, and so forth. And so over the years, we've seen kind of the market select, for certain things. Decentralization, speed, and I think this kind of plays into the success that we see in Ethereum and Solana. They're very different networks, very different philosophies, but they do embody sort of winning strategies, and even to the point where we had protocol ecosystems early on that were very dominant, like Cosmos with Tendermint, Polkadot with Substrate, where some of the really good ideas from those protocols have found their way into some way into Ethereum or Solana, where not directly, but the ideas that were pioneered by those early on protocols were absorbed, iterated on, and improved. And so, of course, the L1 space, the layer one protocol space of staking has seen a lot of consolidation. Doesn't mean that a new incumbent can't come along. There's still, new proof of stake protocols launching every day that think they have a niche either in terms of, better developer experience, higher throughput, parallelization, speed, whatever they're trying to optimize for. So even though we do have, two dominant players in the space, it doesn't mean that we can't have another incumbent come in. However, the race is, fundamentally changing, especially since we have institutional interests, other players coming into space, building on top of the chains. And so it's a little bit of a
Mhm.
different game now.
Ernest, you anything to follow on that, or you good?
Um, no, yeah, just briefly add that um, it's interesting because on the one hand, there's like network effects, of course, to a blockchain. And so, yeah, probably there's a few that it's a winner takes most, I think. And I think that's going to be it's going to be difficult for some of the smaller chains that haven't reached this kind of escape velocity to be relevant in 5, 10 years, I think. But it's also true, on the other hand, that there is space for new innovation and new actors coming in, taking lessons from other chains. And this year we've seen, I think, like three particularly high-profile chain announcements or launches, like Stripe and Paradigm announcing Tempo, a stablecoin-based chain, Circle announcing Arc, another like stablecoin native proof of stake chain, and then Monad, which is another high performance blockchain, kind of similar to Solana in many ways that's been launching. So yeah, it's still evolving a lot, which is
Yeah.
exciting.
Ernest, I'm sure like you guys probably feel this too, but from a like a business perspective, we used to support 50, 60 different blockchains. And, every single year for the last 4 years, like you'd be looking at this time of year, like what are the new, we call them L1s, layer ones, that are going to be launching next year that are going to be interesting to operate validators on top of that clients are going to be interested in. And a lot of times those were um, you know, new protocols that were coming to market that had a lot of venture capital interest, a lot of sort of early community interest, but sort of failed to scale beyond that. And so, like as much as we were adding, new networks to support, we were subtracting at the same time. But the ones that you mentioned, Ernest, Monad, Tempo, Arc, and then I'd put Canton as maybe the additional one there, although we can have a debate as to whether or not that's proof of stake. Those are the ones that we're also seeing a lot of institutions come in and request to build on top of as well. So it's definitely, yeah, the landscape in 2026 is much less scalability, from like a broad base of users, and much more large institutions want to transfer stable value using a blockchain as opposed to using traditional payment rails. And they want to use a blockchain that's been developed within a Stripe or within a Circle or some large conglomerate like that.
Thanks, Josh. Josh, you said something before that kind of shocked me. I wasn't aware of it. Um, ETH, when it started out, pivoted from proof of work to proof of stake. So was not aware of that. I'm going to assume that the typical reasons why was the energy efficiency, the speed of the process. But I'm going to ask a very very ignorant question, guys, and I'm not ashamed to ask this question. Why wouldn't Bitcoin pivot to proof of work? Like is too embedded, too many miners? It's too established. Like, why wouldn't they do that? Or why wouldn't it happen, that
Have
network?
some spears thrown at you, Jim, if you were to go ask that on Twitter right now.
Okay.
Um,
Okay.
so community alignment in Bitcoin is just so different, right? They don't like the Bitcoin community it's not about transaction processing speed. Like the Bitcoin community has really never been about I'm going to use my Bitcoin for microtransactions or micro payments that are constantly streaming from one party to another. Bitcoin is the worst blockchain for DeFi. It's the worst blockchain for transaction speed. It is the best blockchain for probably decentralization and for fundamental believers in what actually constitutes sound money. Bitcoin does those things very well, right? There is a limited supply number where there's a predictable supply number that's achieved because they have a proof of work system. And the Bitcoin's too far gone down the path of being a proof
Okay.
of network to ever switch over.
Okay. Yep. Fair enough.
Yeah, I mean, I also think, like, if you think about the narrative around Bitcoin, it is digital gold, right? That's the way that people kind of conceptualize it now, versus, to Josh's point, like an Ethereum, which originally, world computer. Now I think it's digital oil in terms of the way that people are referring to it. So I think different blockchains, different uses, different reasons to kind of be either proof of work or proof of stake. But I agree. I don't see that ever happening for Bitcoin.
That'll be the last time I publicly make that comment. Hey, Sasha, there's some news today about Galaxy and liquid staking. I don't want to get too terribly deep in the weeds today, technically wise, for the audience, but what is liquid staking?
Yeah, liquid staking, very simply put, is a way for you to earn staking rewards while keeping your tokens usable or tradable through the use of a receipt token. So you would normally in staking stake to a validator or delegate to a validator, and your equity is locked up, right? You're earning rewards, and those might be liquid. However, your principal stake might have an exit window where you have to wait a certain amount of time to be able to withdraw your funds, and this is to protect the integrity of the network. With a liquid token, you receive a receipt token, and it represents your stake deposit. It allows you to auto accrue those rewards kind of as a proxy. It internalizes rewards, and it allows you to have liquidity, to have that token be transferable. Somebody can buy your sort of stake share in whichever protocol you stake to.
Okay. You just mentioned rewards. It's something I'd like to discuss briefly. Are all rewards the same on the various networks? Are they different? Like, what does that landscape look like? And that's a general question to the audience. I mean, to the panel here.
Yeah, happy to take it.
Mhm.
Effectively, so the rewards or the yields that you earn for staking your assets, like yeah, varies for every blockchain.
Mhm.
And the effectively it's a function of like what are the protocol rules and what are the protocol parameters, and um, it's it's always designed in a way to get a sufficient amount of stake onto the network so that there is economic security, like people put actual value at risk and are it sort of enforces that the validators behave in an honest way. And so you typically see decreasing yield as the percentage of the total supply gets staked, as the percentage of the total supply that is staked increases. So, for example, on Ethereum in the early days, when there was a small percentage of the network staking, the yields were higher. Now we have about, I think, 30%, maybe a bit less than that of the Ethereum is staked, and the yield has dropped to about 3%. And so yeah, it's carefully calibrated. And then there's one aspect is like the inflation. So new ETH is created to distribute to the stakers to incentivize them to stake. But the other is typically a portion of the fees of the usage of the network also gets paid out effectively as staking rewards. So yeah, and then there's different ranges. Typically, the earlier chains have higher yield. The reason I
Mhm.
mentioned of bootstrapping the network and just like more inflation. So so yeah, it's
Okay.
it's a mix. Yeah.
Thanks. You just mentioned the word risk. So I want to go there for a second. Allison, we had talked earlier about risk. With all good things comes some risk. So are there any risks with slashing? If there are risks, who's facing the risks? Um, what type of risks are there? How are the risks dealt with? If we can go into that, that'd be great.
Yeah, I mean, I think there's a few things to think about. So, you mentioned slashing. I think we've talked a lot about the carrot, right? So people will stake their tokens in order to be rewarded with new tokens.
Mhm.
There's also a stick, right? So if you're operating a validator and there's some downtime. In most cases, the reasons why you were slashed, sometimes it is for bad behavior on the network, but most oftentimes it's because you're missing a validation. There's some kind of downtime. There's some kind of technical reason why you
And
missed.
what is slashing? Is that like a penalty? Is that what that is?
Slashing is the penalty, exactly. And I'll mention again, this varies blockchain to blockchain. So like slashing is Ethereum has slashing, right? Solana doesn't really have slashing, only in the form of social slashing. So the risks will vary blockchain to blockchain based on how these things are structured. But oftentimes, like even in my conversations with regulators and lawmakers, they'll talk to me about slashing and they think this is a big consumer protection problem. Slashing is incredibly rare. I think it's something like 0.001% of ETH has been slashed to date. So yes, it is a risk. Yes, it's important to have both the carrot and the stick, but I think we also need to remember that though it is a risk, this is not it's a risk factor that you can mitigate, especially with technical due diligence. Like that really I think is the way you mitigate that risk.
Okay. I think, Josh, in one of our early discussions, you said like the risks are, or slashing is network specific. Some of the risks are network specific. Like, what did you mean with that? What does that mean?
Yeah, so some networks have enforceable slashing to prevent you from, or to prevent validators from double signing transactions or double signing blocks, which is like the gravest offense you can make as a as a validator. As Allison was saying, it does not happen very often. But really, like what because when you're validating blocks, you're basically preserving the truth. You're preserving the historical truth of everything that's been shared and spent on that blockchain. So if you are able to manipulate that, if you could, rewire the truth and say that, I actually never sent those two Ethereum to Allison. Um, you would basically be rewriting history. You could give yourself those two Ethereum back that you technically said you sent. So, the whole that is like the gravest worst thing that can happen with a blockchain. Um, Solana, like we were saying, takes a little bit of a different approach where if someone is believed to be a validator is believed to be acting poorly or acting not in accordance with, you know, validating accurate blocks of transactions, all the validators on Solana can socially slash you, right? So you could basically be omitted as a validator in a new version of Solana. But that risk is a lot less than, you operating like the way that you would really get slashed on Ethereum. The number one way is if you were running an instance. Validators usually live in cloud infrastructure. And if your version of your validator were to go down, like if AWS were to have an outage and you had an automated failover to a Google Cloud instance of that same validator, and then all of a sudden AWS shoots back on and you're running two validators at the same time that are validating the same blocks of transactions, you would be double signing. So the whole point is in Ethereum world, if that happens, you lose some of your principal. Each Ethereum validator has 32 Ethereum associated with it. There's a change in Ethereum that actually allows you to have a lot higher balance per validator recently, but you lose some of that Ethereum if that does happen to you. So the risk, especially as a validating company, is much higher for Ethereum because of that risk of slashing versus something like Solana. And other protocols implemented a little bit differently.
So I've got a follow-up question to that, Josh. It's really interesting. What I'm hearing is that if you're guilty of what's called double signing, you use the analogy of AWS going down, popping back up, and now unfortunately, double signed. So there's going to be a penalty for doing that because you're not keeping the true integrity of the network, right? So if you do get
Exactly.
penalized, it's in the form of slashing. And what I'm hearing from you, what you're saying is that if you're guilty of slashing, you're going to lose some of your ETH.
Hmm.
Okay. Who
Yep.
decides that? Is there like a committee? Is there a group of people to decide you screwed up, you're losing it, or it's just built into the network to happen automatically? How does that look like?
It's built into the rules of the protocol.
Okay.
So no one's actually deciding. The protocol is the
Just does it.
ultimate. It's a decentralized network. Exactly.
All right. All right. Follow-up question for you. I'm in risk management. If I feel that I'm being unfairly punished, unfairly penalized for slashing, is there a recourse to appeal to something, or that's it? You just live with it?
I mean, I think the rules are pretty well understood by
Okay.
people who are operating validators. And if you don't follow the rules and something happens, I mean, the penalty routes or the remediation routes are usually not going to, I mean, you could like try and conjure up, you know, go out to Twitter and talk to other validators and see if you could have enough
Consensus. Yeah.
support to roll back the chain, which is also like probably not a good thing to be doing all the time. That means every transaction that's happened beyond the point of when you were slashed also needs to be erased. And that also means that the blockchain is not truly decentralized. So I
Okay.
don't love that as an outcome. What people do, Jim, is they actually tend to have what's called slashing insurance, and off-chain insurance or on-chain insurance that covers, using traditional financial markets,
Right.
the same way that you would have crime insurance or, directors and officers
Yeah.
insurance. You can get slashing specific insurance. That's usually what operators will do. But
Correct.
no one do no, you can't call it Vitalik, who's the creator of Ethereum, and say, "Hey man, I want my slashed ETH back."
No, I think you're right. Alison, you made a comment when we spoke earlier about you think the insurance companies are making a killing on this slashing because I guess there's so few incidents, correct?
Well, I think there are two reasons, one of which I'll get into later. Yeah, one, it's incredibly rare. The other is, so of course, there's many different ways that you can stake, and recently a number of ETPs just went live where you can stake within those ETPs. And here in the US, the way those, without getting too in the weeds here, the way that those products are typically structured is as grants or trusts. And Treasury just came out with guidance, a revenue procedure, and one of the sort of pieces of that guidance says that there has to be complete indemnity. And so you kind of need slashing insurance now. So I think there are two real reasons why now you can. I think the winner coming out of that Treasury guidance is definitely folks who are offering slashing insurance, and it's for that reason because now you have to provide that indemnity.
Right. Yeah, I think I'm with Aon. I think we help. Maybe it's with Allison. I think we're helping all of you here with various exposures in with staking insurance. If we have a question here, folks, we'll take it. To what extent do anti-slashing databases reduce the risk of double signing? I'll read again. To what extent do anti-slashing databases reduce the risk of double signing? This is coming from Rob McKay at Proof
Um,
Insurance, one of the people that we're disparaging.
I can maybe take a stab at this one. So they help a lot. So effectively, the way to mitigate slashing is one aspect is as Josh mentioned, is like to ensure you don't have the types of setups that could cause an accident, basically, like a automated failover, like Josh described. But that's not enough. You also need to have slashing protection, and there's several technical components over the years that have been built by the community to add these layers of protection. One of those is something called Web3 Signer, which is effectively a private key store that ensures that the access to keys is limited to only a single machine at any one time. There's in the validator clients themselves, so that's the open source software that the validator companies run. There's also anti-slashing databases that do something called doppelganger protection. So they effectively, before they issue a new block or they attest to someone else's block, they will check in their internal databases that they didn't already do a similar operation that could cause a slashable offense. Um, and and yeah, so these are all like additive measures of protection. And for a slashing to happen, event to happen, you would need to have all of these things that fail. So as a result, as Alison was saying, it's extremely rare in practice that a slashing event happens. And if it happens, then another important part is like typically the companies who operate large fleets of validators will do very, very progressive changes to their infrastructure. So they'll start with changing one validator and then 10, then 100, then 1,000, so that you reduce the blast radius if something goes wrong. But this is all stuff that, yeah, I think like with the Aon team, I think many of us on this panel here have been pretty yeah, happy with the reception to the explanations on all these practices that can be put in place to get insurers comfortable with slashing
All right.
insurance.
And I'll just give a shout out to the insurance companies that have stepped up and have offered slashing insurance. It's needed in the industry. It's, as all of you can attest here, it's needed. It's being demanded. So a big shout out to any insurance companies that are offering it. And we're always encouraging more insurance companies to get on board and offer some more capacity in the space for slashing or staking insurance. Someone just mentioned the word social slashing. I don't want to get too deep in the weeds on this, but what is social slashing and how's that different, say, from um, other types of slashing? What is is it a Solana thing? Did I hear that right? What is social slashing?
I can pick this on really quick. So social slashing, in opposition to programmatic slashing, where an algorithm has a certain set of rules, right, where they can't tell operator error from malice or anything of the sort. They just apply a set of rules to everybody. Social slashing is the network coming together and deciding to fork you off from the main chain. So essentially deciding to come together and say, hey, this new chain state doesn't include this individual, this actor who we think is a bad actor or is not performing in the way they should be on the network. Therefore, in some sense, we're not going to participate with them anymore. The new chain state does not include them. So that's effectively social slashing. It's technically a possibility by any blockchain that can kind of come together with enough validators to agree on the state of the network. It's not a very common paradigm, and we don't really see this implemented. However, it is theoretically possible. And so it is a way that you could be slashed, even though there are not programmatic rules for a particular protocol.
Okay. Alison, you had mentioned earlier that it's really important to get, I think, really robust participation to make it work. And I think something about security. Or can you describe that a bit? Like, why is it important to have more people involved in staking a network or protocol?
Yeah, so I think two things, right? I think a lot of times when people talk about staking, they're talking solely about percentage yield, or, in some cases, having some of the conversations that we've just been having. But you need token holders to stake their tokens in order for these networks to continue to function properly. And so this is a point we drive home over and over again, especially in talking regulators and lawmakers. This isn't just a nice to have where you say like, oh, no big deal if people don't stake their tokens. Yeah, maybe they don't have access to yield, but no big deal. You actually want as high, I think I can say this, as high of a percentage of the network staked as possible in order for the network to function properly and remain secure. Ideally, you want more than 51% of the network staked, right? And so we were seeing, I think, especially in the case of when when the ETH ETFs were originally launched without staking, being approved, we were saying this could be a big problem because if you have a large percentage of the network that is not staked because they're in these products where staking is not allowed, well, that actually makes Ethereum less secure, and that's problematic. First of all, because of the network itself, but second of all, because of all the things that are built on top of it. We talked earlier about how these proof of stake networks have things built on top. There's a lot of talk about stablecoins today. Stablecoins are built on top of proof of stake networks. If the underlying proof of stake network doesn't function, you don't have stablecoins anymore. So I think it's incredibly important to remember that in the context of staking more broadly, that we need people to understand staking and have sound staking policy because otherwise it's sort of like dominoes.
So I would assume that if to kind of to your point, you need robust participation, right? So I'm assuming higher yields would attract more participation. Yes or no?
One would assume so, yes.
So is there that? So how does that work in the industry then? Is there a way to generate higher yields so that you're containing this robust participation?
Well, I'll just give the blanket answer and then I'll let these folks step in. I mean, as Josh said earlier, the reward rate is set by the protocol, right? So if people are talking about giving you a yield on top of what the protocol is emitting, that's probably some different kind of product, right? So while I do think there are ways that you could certainly adjust the reward rate, that's being set by the protocol. Now, if you're using a staking as a service provider, of course, folks have different rates that they charge in
Mhm.
order for those services. Um,
Okay.
but largely speaking, I don't think we can say like, oh yeah, it would be great if you got 25% for staking your soul, but that's
Okay.
something that's determined by the protocol.
Yeah,
Okay.
to also to just put a stamp on that, Allison, completely agree. I think Galaxy, Kiln, and Figment would not be in business if staking was truly like a commoditized business and you're only earning the rewards rate that the protocol is stated. Like the reason you would use an institutional validator or even the difference in performance that you can achieve, and this is probably more for networks like Solana and others where there is kind of there is a higher rewards rate. You can influence some of the performance metrics that go into running a validator, which give you more opportunities to propose blocks, which means you're earning a higher percentage of transaction fees, which are one of the two components that make up the rewards rate. And a lot of that's not gonna happen if you're a hobbyist validator or kind of doing it yourself. It's the same thing as like if you were to run a Bitcoin node at home and or Bitcoin mining rig at home, and you have a couple of ASIC units plugged into a wall. First of all, your cost of electricity is going to be astronomical. But second, you're probably never going unless you're participating in a mining pool. You're never going to mine a Bitcoin block on your own. So there is a reason why people tend to go to a larger validator on these networks because if you look at the network average of other validators, institutional validators are always going to generally outperform that. But to Allison's point, the one thing that I think we would all agree on, we really can't outperform is the inflationary schedule of each network, which is the new tokens that are issued and given to the validator for proposing a block. So there's other things you can do on the periphery. If someone is really like if you're looking at an Ethereum validator, and Ethereum's rewards rate is somewhere around like 2.8 to 3%, and someone tells you they're going to get you 7 or 8%, to Allison's point, they're taking custody of your tokens, which we're all, for the validation services that we all offer, it's generally non-custodial. We're not taking your assets. You are delegating your tokens to our validators. If someone's getting you 7, 8, 9% on Ethereum, it means that there's other things happening. They're using DeFi protocols, they're using vaults, they're putting your funds at risk. And Allison was
Okay.
talking a little bit about like the ETF process and the fact that we now have regulated structures in the United States that offer staking within them. It was very clearly called out that protocol staking is what's allowed in these structures, not anything else beyond that. So that's kind of the differences.
So, Josh, you mentioned Bitcoin a few minutes ago. I've been approached by a number of companies last few months, more so the last month or two, saying that they're engaged in something called Bitcoin wrapping, wrapping Bitcoin for staking purposes. Are you hearing about this? Does this have legs? Is this something that's going to continue to grow? Any thoughts, guys, on Bitcoin wrapping for staking? No?
The hot potato, Jim.
It's a hot potato? Yeah.
You want to take it?
Well, first of all, what is it?
Uh,
Like, what is Bitcoin wrapping
I
for
like
staking?
I like potatoes. I'll take it. Um, I think so. Yeah, Bitcoin staking, I think is maybe the term. I haven't heard Bitcoin wrapping too much,
Okay.
although
Or
there is
wrapper.
also something called wrapping, which is when you represent Bitcoin on another chain, like wrapped Bitcoin. But Bitcoin
Okay.
staking is effectively the idea of trying to use Bitcoin as a um, collateral asset um, to secure non-Bitcoin, like other blockchains, um, in order to be able to do to run the kinds of things that cannot be run on Bitcoin, because by design Bitcoin has very little functionality. And so there are several Bitcoin staking protocols, such as like Stacks, Babylon, um, Core, DAO, etc., which and Botanics is another one, which effectively enable users to kind of lock up Bitcoin to earn the right to validate on another blockchain, and that other blockchain can do other things. In the case of Babylon, it's like well, it's a bit hard to explain, but it's effectively like a marketplace of applications. Um, and so, yeah, it's a pretty new trend, Bitcoin staking. It's important to note that it's not like it's. I would think it's important on the risk side to note that it's quite different from native staking on a layer one protocol. But it's definitely an area of like a lot of interesting innovation.
Okay. So we got about 15 minutes left. There's a lot still left to cover, but one thing I want to make sure we definitely get to is regulatory update. Allison, Josh, you've been both very, very busy in DC. Huge appreciation for all your efforts in the industry. Can you give us an update on where are we with the regulators? Where are the SEC? Tax has always been a big issue, the IRS. Would love any update with regulatory and staking. Where are we?
Yeah, how much time do we have? So I'll try to keep you brief.
14 minutes.
Perfect. So I think historically, so maybe let's look backwards to look forward, right? So take the security side first and the tax side second. So under the previous administration, you had first the Kraken settlement with SEC, where they were alleging that their staking as a service offering was a security. You had the Coinbase case where they alleged basically the same thing. When the Coinbase was sued, there were also 10 state regulators that followed the SEC in suing Coinbase for their staking as a service, their staking as a service offering. Um, and so I think there was a lot of hesitation, and folks were sitting on the sidelines because it wasn't necessarily clear that if you were offering a staking as a service, business wasn't going to be viewed as a security. Now, let me just back up and say this is a technical service to the conversation that we've been having over the past 45 minutes. So now, fast forward, you had in early 2025, the Coinbase case was dropped with prejudice, which means they think the SEC got it wrong. 3 months later in May, SEC issues guidance that protocol staking is not a security, and that if you offer a number of ancillary services surrounding staking, those are not securities either. In August, we got guidance from the SEC that said liquid staking is not a security. So to the receipt tokens that we talked about earlier, that's more of a bailment relationship. It's like any other digital commodity. I'm not expecting to get back the exact same wheat that I deposited in a warehouse, right? I have a receipt token for that helps me go in and claim it. So also that not a security. So a lot of clarity, I think, in the market. And I have the market structure bill, which is still progressing, that has some very sensible provisions around staking. So I think just in the past year alone, kind of huge steps forward, as Josh said, and we've talked about a little bit, ETFs with staking now live here in the US. And then I think on the tax side, what's interesting is we still do need tax clarity, and that's as pertains to the timing of taxation on staking rewards. So right now, under IRS guidance that came out in 23, you're taxed as ordinary income on staking rewards when you receive them. And then, of course, they're also when you sell. We believe that this is erroneous. President's Working Group report basically came out and said shouldn't be as well. This should be revisited. And so we're hoping that we'll get legislation soon that said they should be taxed at the time of sale, not at the time of creation. Sourcing, right? We think that you should the source of this income should be taxed to the jurisdiction of the taxpayer, not necessarily the jurisdiction of the infrastructure. And then also on the structuring side, as I mentioned, like one of the key reasons why we didn't see these staked products earlier, yes, there was a barrier at SEC, but we needed treasury guidance that basically outlined how these things could be structured. We now have that guidance. So I still think there's a lot that still needs to be done. We're still pushing for legislation on the tax side. Market structure legislation still isn't done, but just it's night and day, I think, in terms of where we were last year when Josh and I think it was almost a year to the day, we were down on the hill talking to people about the importance of staking in ETFs, and just we've come a very long way since.
So is that night and day I'm talking about the day part now. We're in a better, say, administrative understanding. Administration understands the the. Are we, say, in a position today where more institutions will get involved now because of this regulatory clarity? Are we seeing that?
I think that's why you're seeing more institutions get involved. I think a lot of that money was sitting on the sidelines because we didn't have the regulatory clarity that we need. And like that tax and structuring clarity is just as important as the regulatory clarity. And so I think those things coming together, you're now starting to see those pieces of the puzzle come together. And I think it's great that we have the
Yeah.
guidance that we have. If we actually get that cemented into legislation, I think that will open the floodgates because we'll have certainty for the long term.
Yeah.
And you see more institutions getting involved, Allison, obviously going forward.
Yes.
Yeah. Josh?
I was just going to say, like, if you think about the step one for institutions, it's generally to launch an ETP or an ETF. It's kind of the fastest way to market, quickest way to solve the need for your customers. If you're a Fidelity or a BlackRock or a VanEck or whoever, if you're a fund manager, the quickest way for you to get your clients into this asset class is to launch and build a fund around it. And there was no way for people to do that with staking allowed. And like, honestly, Allison is probably the reason we've gotten there in terms of, probably endless hours on Amtrak going back and forth to DC. But, it is completely different. Like we are, from my perspective, I used to work at Fidelity and we started thinking about these things back in 2017. Um, and now today we have almost 6 billion. I mean, we have over $6 billion of ETF assets that are being staked in the US. And we weren't the leader on this. Canada had staking in ETFs before we did. Switzerland had staking in ETFs before we did. So this is within the last um, month and a half that we've had staking in ETPs. And so, there's a lot more room to grow. BlackRock has not converted their, large ETF to include their ETH ETF, which has, I don't know the price today, but back a couple weeks ago was $20 billion, which is one of the most successful ETF launches in the company's history, is an Ethereum ETF. Their most successful launch in company history was their Bitcoin ETF. So it is completely night and day, and that starts to attract institutional allocators. Harvard's 13F came out last 2 weeks ago. The largest publicly disclosed position at the Harvard University Endowment holds is BlackRock's Bitcoin ETF. So I think, Vanguard this week said Vanguard's been historically against, or been just historically loud that they're not going to launch their own crypto related products. And, they had hesitation for adding crypto products onto their platform. This week they came out and they unlocked that moratorium. And you can, if you're a Vanguard customer, you can go buy crypto ETPs on Vanguard's platform. So I think like the fact like we were not even having remotely close to these conversations last year. Like if you wanted to talk about crypto ETPs, you had to get on a plane and head to Zurich. It was not available here. So it is a
Wow.
completely changed environment.
So I thought I heard one of you say on one of our earlier calls that there's been ongoing and will continue to be margin compression on margins. If that's the case, would that be somewhat prohibitive for the institutions looking at the industry? So, wow, these margins are being compressed. Maybe it's not worth it. What's the logic there, guys? Or is there any truth to that? Is there margin compression? If
Yeah,
so, yeah, go ahead.
I can take this one on a bit, and just really quick to add to what Josh and Allison said. I think it's really interesting. The U.S. is really setting the stage for the rest of the world, right? With U.S. policy being developed and the clarity that's emerging. Yes, there are other first movers, but once the U.S. moves, we really see the rest of the world really unlock with this. When it comes to margin compression, I mean, essentially it's competition has increased a lot, right? The underlying revenue, the protocol rewards, the becoming more flat, staking is more commoditized, but the block space and what people are building on top of it is still very, very important. People can still build applications, put stable coins on chain, build actual revenue streams, real world assets, and so forth. So even though staking is becoming commoditized, it's sort of like the access to the block space being able to have, that validator presence allows you to participate in the crypto economy and crypto space and create value on top of that as a primitive. So Staking matures, yes, there's reduced risk, reduced incentives. Even when we talked about inflationary rewards, right? When a protocol first launches, that's usually when the inflationary rewards are the highest, right? You're paying the most for economic security to incentivize everybody to come in. And over time, those rewards decrease, right? You have enough players, you have more than 51% of the network in terms of tokens staked. There's other reward types that become more prevalent, which could be the block rewards from actual organic economic activity on the network. It could be MEV, where people are participating by reordering transactions, making the network more efficient. It could be things being built on top of it. So I think it's just a maturation of staking, and it is somewhat expected. However, for an institutional player or anybody else, having access to the block space, right, and the future and the promise of all that entails, I think that's what makes this very enticing.
So what I'm hearing from you, Sasha, is that from an institutional perspective, it still makes sense to get involved.
Yeah, I
Yeah.
would say so.
Okay.
It's early.
One question that came up, or one topic that came up, one of our early calls was consolidation in the industry. Um, do you see consolidation going forward? If so, what's to put a crystal ball in front of you? What does that look like?
Jim, do you mean like staking providers consolidating or
Correct. Correct.
consolidating? I mean, we're
Correct.
we're talking about network consolidation, right? Like we're seeing less L1s come to market that have staking. Well, the ones that do are coming from extremely well, funded companies as the development, foundation effectively that's launching the protocol. So I think we're seeing maybe not a consolidation, but a slowdown in the L1 space. In terms of like staking providers, I think probably. But I also think that means that, look at the evolution of the early providers who are staking. Like you have Coinbase who acquired a company called Bison Trails. You have Kraken who acquired a company called Staked. So I think like if you're an institutional exchange marketplace custodian and you're looking at, your fee compression on your assets under custody, and you're trying to think of creative ways to add some revenue line, like the easiest way to do that is staking. Like whenever we're talking to a custodian or an exchange, the first thing is either custody or trading, and then the next thing is immediately staking. So I think like as more like we talked about, some large institutions coming into the space wanting to offer brokerage services, wanting to offer custody, they're going to want to have that capability in house, especially, when they see how much they're earning on custody fees. So I
Great.
think that'll lead to a little bit of consolidation.
Great. Thanks, Josh. We have a question here from Jean or Jean Lewis. I heard you can stake Solana and receive BTC through Zeus Network. Any thoughts on that? Uh, Not hearing much on that. So,
I have not heard of this particular network,
okay.
so
All
cannot
right.
comment. Then
Fair
maybe
enough.
someone else
All
has.
right. Guys, we have a few minutes left. In the interest of time, I'll do this very quickly. If I put a crystal ball in front of each one of you, four of you, where do you see the staking industry in 3 years to 5 years? Just quickly, some quick thoughts. Do you see any major changes? Do you see it continuing the way it is? Any innovations? Just real quickly, what do you think?
Um, Maybe I can start. So I think one thing we should see is more um, kind of institutional players get involved. So either through, as we mentioned, like potential consolidation, but also spinning up their own operations, because as they start to move more material financial flows and assets on chain, effectively being a staking operator is a way to be kind of a citizen of the blockchain. And I think like they're going to want to really get closer to the metal to understand how the protocols evolve, exactly which types of clients to run, what are the dynamics of the development teams, what are the roadmaps of the protocol. So I wouldn't be surprised if we see like for example, the payment companies that are going big on stablecoins start to also become validators. At least for the
Okay.
chains that they're part of launching, like the
All right.
Tempo and Arc and stuff that I mentioned earlier, but also for Ethereum and Solana and the other big smart contract chains. So that's
Great.
maybe
Thanks.
one
Thanks,
prediction.
Ernest. Sasha?
Yeah, I think going off of what we heard earlier, a lot of regulatory clarity when it comes to a lot of those questions from the IRS, SEC, around taxation status, right? Allowing more players to come in, and even as we see margins compress, we see more people building on and around these networks and creating new systems of value, building below the networks. So there's this project called Double Zero, which is a private fiber network. They're trying to scale Solana that way. People are building L2s, roll-ups, applications that utilize the underlying network security of these protocols and build applications on top of that. I think we'll probably see a lot of, real world like equity market parity on chain. I mean, this is a decentralized system. It is more efficient. And I think with the clarity, you'll see people building, new things. We've seen some innovations in the space like perpetual futures, but I think I'm looking forward to seeing other things that exist, on NASDAQ, on
Great.
chain, but also new things as well.
Great. Thanks. Allison?
Yep, I'll be brief because I know we're at time. I think we're gonna see growth and we're gonna continue to see innovation. 3 years ago, you didn't have liquid staking didn't exist. You didn't have folks that were playing in the institutional space. I think the space will continue to innovate and it's just going to continue to grow.
Thanks, Allison. Josh?
I guess maybe less DC trips for Allison and I. Like I think we have a good regulatory regime now. Hopefully a lot of this gets codified into law. I'll make like a bold prediction and I'll say I'd love to see like, retirement account standards. So like a 2055 or 2065 retirement account, kind of blended portfolio hold staking ETP in it. Like I think that's a huge win for us as an industry, is if we can find a way to crack into 401k.
Great. Fantastic. Allison, Josh, Sasha, Ernest, thank you all very, very much. Fantastic conversation, guys. Greatly appreciate all your time and your contribution. We'll be in touch again. Thanks, everybody.
Thank you.
Thank you.
Bye-bye.
Take care,
Thanks.
guys.
Cheers.